Fine, good. Good morning. Thank you very much for inviting me. It's a great delight, great pleasure to be here to talk about a paper on institutional investor activism in relation to political connections and political activism by companies. This is joint work with Rui Albuquerque, Xicheng Lei, and Jenny Zhang, and it really relates to the landmark decision on Citizens United in 2010, one of the, you could say, most important changes in legislation, regulation on,
Something is wrong? No, it's okay.
Yeah. Okay. Great, thank you. So one of the major, most important changes in legislation, regulation regarding political expenditure. And we in particular are interested in looking at how this change affects stock prices, how it also affects the decisions made by institutional investors. And it basically goes back, probably as many things or most of things we discuss in economics today, to Adam Smith. Adam Smith already talked about the fact what happens if those who amass capital also engage into politics. And he basically concludes, and this is the last sentence here, one should not only take the most scrupulous, but also the most suspicious attention if there might be an impact, or say there might be an attempt by those amassing capital to get engaged into political decision processes. So what is Citizens United all about? This is the landmark decision by the US Supreme Court in January 2010. Basically, the full title, Citizens United versus Federal Election Commission. Basically allowing for the first time that corporations can also engage in political spending, something that was more limited, or that was allowed only in a more limited way before. Now, the bans that were existing before are lifted. So therefore, companies can now much more easily get engaged into political activism beyond the other types of political activism they used to before. I will talk about a couple of them. You can obviously think about lobbying, about political connections, and other types. And you more or less can think of this, and this is the basic story of this paper, of political activism being a production process with different production factors. And all these production factors come with a certain cost. And before Citizens United, you could say that whatever in money contributions was done had an exhibitly a very high price. Basically, it was not possible to do so. Now, all of a sudden, this production factor becomes available, and the question is, what does it mean for the whole production process of political activism? What does it also mean to the value of other input factors for political activism? So therefore, this is a new avenue, a new production factor that all of a sudden has, you could say, a dramatic decrease in price. Not surprisingly, when you look at the political spending in the US, based on various election cycles, you can see that there's a dramatic increase between 2010 and 2012. So the change really resulted in massive additional spending by corporations to get engaged into politics, and this is really the day, this 2010 is really the day that we are focusing on in our analysis. So obviously this whole decision created a lot of controversy on the political side, but maybe, and this is more interesting and more important for the purpose of our study, also on the perspective by certain investors, certain agents in financial markets. So to start with, just a week after the ruling, President Obama voiced serious criticism regarding the decision. In his State of the Union address, he said basically the Supreme Court reversed a century of law that will, in his view, open the floodgates for special interests. So he was very concerned that now special interests can actually get engaged in political decision-making, potentially buying political decisions in their interest, and thus completely change the democratic process, in particular in favor of those who have the most powerful interests. More or less, you could say, coming back to what Adam Smith had already said more than 200 years ago. Now, and this is probably the more interesting part for the purpose of institutional investors. There's also there's a bunch of different reactions to this by various groups of basically stakeholder groups, institutional investor groups, on whether this is really the right way to go. And for example, there are different letters, different announcements by different stakeholder groups regarding this decision and criticizing this decision, and in particular putting pressure on companies to make use of the new opportunity only in a very limited way, in particular to show much more transparency in using this type of new opportunity. So for example, there is the Center for Political Accountability, CPA, the Council of Institutional Investors, and they were joined by nearly 50 institutional investors writing a letter to almost all, I mean, let's say vast majority of S&P 500 companies that at that point of time did not have any disclosure on political spending, and they urged them to increase the transparency on political spending, and in particular to adopt rules that it's clear how and when those political donations are made. Also, when you look more specifically at two of the most well-known, biggest institutional investors, CalPERS in particular, they were also given clear instructions or clear expectations by the California Treasurer how and when to get involved. And in particular, what is also interesting as a result, which comes back to what we are specifically interested in, is that companies saw a 150% increase in shareholder proposals on the disclosure of political spending. Often, this was triggered by public pension funds. So therefore, what we are basically interested in is obviously first to see what is the reaction overall to Citizens United, but we are most interested in the distinction between different types of institutional investors. In particular, we are interested in what actually happens if these companies have a significant share of public pension funds. So you could say pension funds under some type of public influence. What is interesting is, and I think this is also for us was one of the most important part in this study, is that there's not only the ruling Citizens United basically on the US-wide level, but also that there used to be bans or no bans in state elections in some states and not in other states. So therefore, there's now, this ruling also implies that all these bans are taken away. But, and this is from an econometric perspective, the nice thing, that there's a difference between, you could say, control and treatment groups. So we have some states in which there were no state bans before, and they remain no state bans. In other states, there were actually bans, sorry, there were bans, and at a later stage, these bans were taken away. So therefore, this is now something that we will explore in a difference in difference setting, or you could also say a triple difference setting, in which we have before and after different types of composition of institutional investors, particularly public investors, and then the question of whether this is a banned state or not. So basically, the questions we are after is, first of all, thank you. First of all, is there any stock market reaction after Citizens United? In particular, is there any difference in stock price reactions based on what type of ownership these companies have? So this means in particular whether these companies have public pension funds as their owners. And we look specifically at those previous types of political connections types of political activism, meaning political connections, and see whether companies that actually created these political connections are now doing differently in terms of their stock price response. Then also we would like to see, as I said, the difference between different types of investors to see how this affects the changes in their actions. Second, and this is what I just briefly referred to, is the question of the state level consideration. So the state level consideration is that in some states there were bans, which are now not longer existent. In some other states there were no bans, and there remain to be no restrictions. So therefore, it's basically, you could say, a classical diff and diff treatment control group differentiation about band states versus non-band states. And in a sense, I think I like this quote or this insight by Isharov and Kalan, who basically say that campaign finance is, you can view this as a hydraulic system. Wherever you try to push it down, it will appear somewhere else again. So therefore, whatever you try to restrict on one side may actually show up at another place. So what are our main findings? The main findings are, first of all, starting on the US level. On the US level, what we find is that companies that have political connections before Citizens United lose in value in an event study type of setting. The interesting part, though, is that this loss is only concentrated in those firms that have a high level of public pension funds. So it's really the interaction between public pension funds and the levels and actually the existence of political connections that really drive the stock market loss. So therefore, what we are basically arguing is, given that most likely those firms that have high level of public pension funds and public pension funds being opposed to the new regime the Citizens United created, they actually would not allow their management to engage into other types of political activism. And this means this input factor that they had before that actually was quite valuable, now becoming much less valuable given that other input factors derived or deprived much of its value. Second, we also look at what happens in terms of their action. So we find here that firms with zero public pension fund ownership, afterwards the number of state-level political connections is lower. So in that sense, put it differently, those with high-level public ownership by public pension funds, have higher political connections. So for them, if they still want to engage into political activism, they keep the one variable they had. This means, or maybe they even expand the one variable they had, meaning political connections, but they did not, they could maybe not, engage into other types of activism, meaning in particular to spend more money, so to increase donations. So therefore, this seems to suggest these restrictions put on these companies by public pension funds are important and really play an important role in what these companies do going forward. Finally, we also look at the question, what does it mean for actually trading decisions? Because that obviously is the most imminent or say most immediate way of how to think about reacting to these changes. And here, what we find is that public pension funds significantly increase their ownership in firms with the average number of state connections in band states relative to those in no band states. So again, showing that they are interested in increasing their exposure to those types of, say, you could say, traditional types of political connections. Briefly on the related literature, obviously this paper relates to a couple of, well, you could say different angles of the literature. The first one is on public pension funds. Public pension funds have been analyzed with more and more intensity over recent years. Maybe one paper I'd like to single out, even though all of them have very important relations to ours, is the second one by Hochberg and Rao. And then basically say that public pension funds exhibit substantial home bias in their investments in private equity, despite the fact that these investments actually perform more poorly than the investments they would do elsewhere. So suggesting that there might be a home bias, a non-justifiable home bias by those investors. Second, there obviously is also a substantial literature on Citizens United, so on the question of what actually happened after Citizens United. There are various aspects that have been looked at, for example, in particular with respect to the market reaction, how markets react to Citizens United. What actually does it mean for the increase in political spending by corporations now that they have the opportunity to spend the money on it? What we are viewing as our main contribution is here to not only look at the stock price reactions overall, but rather to see how in the cross-section does this stock market reaction, or is it driven by other characteristics, in particular the question of public pension funds being there or being not there in these companies. And then finally, there's a even probably bigger literature on the value of political connections in stock-listed companies in the US and elsewhere. I would say the seminal paper by Ray Fishman on Indonesia, the question of how actually the health status of President Suharto at that point of time affected the stock prices of those companies being related to the Suharto family and those firms not being related to the Suharto family at a point of time when apparently there was bad news on President Suharto when he had to undergo medical treatment in Germany. And I hope the negative part was rather being the part of medical treatment, not the part of that taking place in Germany. So that is basically the starting point. Then obviously there are other papers to look into the value of political connections and also how and why these political connections are playing a role in why actually companies may benefit from having those. So, for example, procurement contracts, likelihood of bailout, likelihood of getting better access to finance, and so on. Okay, so now in terms of the empirical results, so we first just look at pure announcement returns. And the announcement returns show that if a company has a political connection, so this means if a board member of this company is a former politician, someone who has political experience, then this means upon announcement of Citizens United, the stock price of the company with this political connection goes down on average. Controlling for all kinds of other factors that may explain this return. Now, what is more important for the purpose of our study, if we now do an interaction between companies with high public pension fund ownership, so this is this abbreviation PPF, then what you can see is that the connection all of a sudden may not be consistently significant anymore, but rather it is the interaction between connection and high level of public pension fund ownership. So this really means those companies that have a high level of public pension fund ownership and have board members with political connections are the ones that are affected most. Most likely given the fact that public pension funds don't like these companies to engage in other types of political activism, but rather restrict themselves to just keep what they have, given that this input factor now becomes less valuable, thus also the company that has this political connection going down in value. Then, sorry, and this might be too small, my apologies for this right away, is the question of what happens in banned states versus in non-banned states. So again, those states that were affected, that are our treatment group versus the control group. And here we find that, in particular, when we look at this triple interaction, so this line here, so the triple interaction between banned states, post-dummy, and a high level of public pension fund ownership, that in this case, the number of political connections relatively to the others tends to increase. So again, showing that others may actually now find other opportunities to get engaged into political activism. These companies only can concentrate on what they actually had before, not engaging in additional money spending. Then, furthermore, also looking into, you could say, put your money where your mouth is. What does it really mean in terms of buying additional stakes, additional stock in these companies? And here you can see again, and this is again the triple interaction term between banned states, meaning post Citizens United times the connections. Here there seems to be a tendency to increase the stock holdings in these companies. So this means it's again giving evidence for the fact that the new options cannot be used by these types of companies, but rather they engage in the more traditional types of political connections. Then a couple of robustness tests. I won't show all of them, but just to show you one very important one, because as it happens, the very day on which Citizens United was announced coincides with the day on which also major parts of the Volcker Rule were announced. So therefore, obviously, one may argue that it's not really Citizens United, but it's rather the Volcker Rule that drives our results. So now you may say, obviously, maybe the Volcker Rule could have been already anticipated, so maybe it's not a full surprise, but what we do is, specifically to address this comment, is to drop financial firms and the results go unchanged. A couple of other robustness tests we undertake, maybe, but this may be probably being the most remarkable or the most important one. Then also we run a placebo test in various types of forms. That again does not show any significant result, or basically this does not show a significant result in contrast to what we look into in our event date. And then maybe the last one, this might be a little bit more a subtle one, it's just a simple alternative hypothesis. So maybe these results are not completely not driven by what we have in mind, but rather by something different. So which could be that it just happens to be that high public pension fund ownership firms have political connections that have a higher value than than firms that have less or basically zero public pension fund ownership. This means at that point of time, it could equally be consistent with the results we've seen on the empirical side. So then the question is, how do we value the political connections that a certain firm has? And the one element that we use here is from a previous paper, which someone actually has referred to as the Teabag effect. So if you have a former politician, and this former politician now joins a corporation, then the first company that can enjoy having this politician gets a stronger effect than the second company, just because the political effect gets weaker and weaker the more companies this politician joins. So this is one effect that we have found or have established in an earlier paper. So therefore we use this Teabag effect, so the order of nomination, to figure out whether this actually has an effect, so basically figuring out whether this quality indicator of political connections plays a role. We can't find any evidence on this, so therefore, at least according to this type of quality variable, we cannot find that this alternative hypothesis of quality, difference in quality of political connections actually may play a role. Okay, so therefore to conclude, so what we are looking into is this major shift in bans or lift of bans in political connections. This means the major ruling on Citizens United versus FEC. And we look into how valuable are these political connections afterwards. What we find overall, they lose, companies with connections lose their value, but the most important part is that this is concentrated within those companies that also have a high level of public pension ownership. So it's not across the board, but really concentrated in those. And we find further evidence when we look at the cross-section between different US states, so those being in the treatment and the control group, that this new avenue of political activism cannot be used by companies with high levels of public pension ownership. So therefore, there seems to be, according to this evidence, quite a significant difference in terms of what happens to different input factors of political activisms between those who actually have investors who don't have a say, who don't put restrictions on it, versus those public pension funds that actually put restrictions on it. Thank you very much, and look forward to the comments.
Thank you.